When it comes to buying a car, most people focus on the monthly payment. If it fits within your budget, it seems affordable. But this strategy can unfortunately quickly drain savings, delay your goals, and impact your financial plan. The truth is, buying a car is oftentimes one of the largest financial transactions a family will make outside of buying their home. And just like buying a home, buying the car should fit within the broader financial plan. Today, we're going to talk about how much car you can truly afford, how most buyers end up overspending, and how a simple framework like the 24-10 rule can actually preserve your financial plan, keep you on track, and protect your long-term goals. So how much car can you really afford? Something like this or something like this?
Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Since COVID, it seems like the prices of cars have skyrocketed. And it's a little bit true. The average price of a car today is $50,000 within the United States. And the average monthly payment that people have on those vehicles is $750 a month. Part of the reason for the rise in costs have to do with inflation, but also has to do with the fact that consumers have become more accustomed to what once were considered luxuries, now being taken for granted as standard equipment. Things like 360-degree cameras, self-driving, heated seats even, are taken for granted, when in the past, those were luxury items that were add-ons to cars for people that could afford them. Over the last decade, consumer preferences have also shifted heavily towards larger, high-priced models. Trucks and SUVs now make up the majority of vehicle sales, and their higher cost pulls the average price higher. So while the data might suggest cars are getting more expensive, it's also that buyers are choosing bigger, more advanced models. What's concerning is that to make these high prices work, buyers are stretching loan terms longer than ever. 6, 7, and even 8-year car loans have become increasingly common. On the surface, that sounds great. You get a lower monthly payment, a nicer car, and what feels like a manageable expense. But longer term loans mean higher total interest, slower principal paydown, and greater risk of owing more than the car is worth. Cars are generally one of the worst depreciating assets that money can buy. So the risk of becoming car poor is definitely high with a longer term loan. You're just giving yourself that much more time for your car's value to decrease the amount below what you actually owe. That's why it's really crucial to have a clear plan in place before you even go to the dealership. Remember that car dealerships are trying to sell you a car, and oftentimes they'll ask you what you can afford, but all they're really doing then is just adjusting the loan term and payment until it becomes something that looks more affordable. If you can have car A for $700 a month or car B for $500 a month, you're going to likely choose car B if they're the same vehicle. So what they generally will do is just extend the loan term as far out as they can to keep that monthly payment as low as possible. What you're not generally talking about in that negotiation with the car dealership is how much more you're paying in interest to reduce that monthly payment. So instead, shift the conversation away from monthly payments and focus on the total price of the car, all in, interest included. And better yet, start with a framework that keeps your finances balanced. One example of this is the 24-10 rule. The 24-10 rule is a simple but powerful guideline that helps you determine how much car you can truly afford without jeopardizing your broader financial health. The 20 in the 24-10 rule refers to 20% down, or a 20% down payment on your loan. This helps ensure that you stay within reason in your car purchase. You're not going to go too far ahead of what you can really afford because you still need to put a good chunk of money down. And you give yourself a little bit more cushion to that depreciating asset that is your vehicle. So it's a little less likely that you become car poor quickly if you have a longer term loan. And on that term, the second number, 4, refers to a 4-year term. 4-year term is oftentimes the sweet spot when it comes to the amount of interest that you pay and also not extending too far beyond that depreciation ladder. If 4 years keeps the payment a little too high or it seems a little too tight, you can oftentimes negotiate a 5-year loan, but then begin paying on a 4-year schedule. So you pay it down faster, you pay less in interest, but you have the flexibility to reduce your payment in a pinch. Finally, all your car-related expenses, including the loan payment, insurance, fuel, and maintenance, should be below about 10% of your gross monthly income. Cars are often the second largest expense after housing, so keeping that ratio in check ensures that you're not derailing your ability to save, invest, or pursue other opportunities. When you exceed that 10% threshold, you risk what's called becoming car poor, meaning that you're spending too much money on your car and there's little left to use to build wealth. That being said, every situation is unique. That's why at Pacific Wealth Management, we always run major purchases like vehicles, for example, through a client's broader financial plan. We look at the issues of how it could affect their savings rate, delay retirement contributions, or change their ability to handle an unexpected expense that might come down the road. By analyzing our clients' cash flows and long-term projections, we can see exactly how a car purchase fits into the broader big picture around their goals. Sometimes that means confirming that they're in great shape to buy whatever they want. Other times that means adjusting the price range so the rest of their financial goals can stay on track. To sum up, here are a few key points to remember. First, cars today cost more than ever, but that doesn't mean that you have to overspend. The key is to have a clear plan in place before you go to the dealership. Second, use the 24-10 rule. It's a simple framework that you can use to map out how much car you can truly afford. It'll help you determine the budgeting and borrowing limits that will allow you to maintain your financial stability. Third, longer loans might look affordable, but they cost you more in the long run and can keep you in debt that much longer. And fourth, every major purchase should fit within a broader financial plan. Overall, the goal isn't to buy the cheapest car possible, but to buy it within a structure that supports your larger goals. I'm Justin Kuntz, Managing Director of Pacific Wealth Management. And if you're interested in learning more about how we help our clients plan across many generations, visit us at www.pacwealth.com.